do you get the absolute best interest rates on loans, credit lines, and business credit cards? Look, it makes a huge difference. If you pay too much interest or too short of a term, then you are borrowing a lot of money at a very massive payment. But here's the problem. If you do that, and then versus the alternative, which is you actually come in and be able to get better terms, then you get a longer term, a lower interest rate, and you can get a lot more money with the exact same payment or even less. Here, let me give you an example. First loan we ever got, $75,000. Payment was about $9K a month. That's a short-term, high-interest loan. $75,000 we got, $9K a month. Now, we were able for our second loan, listen, big comparison. We were able to get $325,000. So what, $250,000 more. And what's interesting is that our payment was only $4,600. So how the heck do you get over $200,000 more in funding and have a payment half as much? Two things, rate and term. And what I mean by that is the term. How long is the loan? What is the interest rate? That determines what your payments are actually going to be. And yeah, it's that big of a deal to be able to get $250,000 more money with a payment half as much. So you've got to be able to get the best terms on the money you get. And today I want to walk in and talk to you about how to get the best interest rates on the future loans you apply for. I'm going to walk through my best strategies that I've learned in 2 decades of helping business owners get money so you can actually take this to heart, make a few tweaks, know what to look for to get significantly more money with cheaper payments by getting the best financing terms. So let's start right from the beginning. One of the first things you want to do is you need to build and maintain good business credit. I'm going to show you real business credit reports right now, and I'm going to show you why this is so important. Look, business credit is as important to you getting approved for the most money at the best terms as a business as consumer credit is for you as an individual consumer. And when you do this correct, well, this is what gets you higher credit recommendations. Here, I'll show you. So we're going to take a look at 2 credit reports, right? These are both Experian credit reports. Now, there's a few things I want to show you. The first thing is that if you want to get better terms on the funding that you're actually getting, then there's 2 things that come into play. The first is how much money you're going to get. Now, the bureaus actually recommend to the lenders how much money you should be lent. So if you want to get higher approval amounts, you need to build business credit, because the more you build business credit, the higher the recommendation of credit is. I'll show you. If I scroll down on this credit report, you're going to see there's only one account here, trade payments. There's only one account here. And because there's only one account, not a lot of credit history, Experian's only recommending this person be lent $2,500. Now check this out. This person is being recommended for $724,000. Let's admit that I would much rather be this company where the bureau is telling the lender to give me $750,000 than this company where we're only able to be re-recommended for $2,500, right? But the difference is if we look at the second example, and I've got a bright light shining, I'm trying today, so I'm having a hard time finding my mouse. If we look at this second example, then we're actually able to come down here and we're able to see under trade payments, they have a lot more credit. So the more business credit we build, the higher the recommendation of credit is going to be. But here's the difference as well. When we look at a credit report, when we determine the rates we're going to get, it's all based on these 2 factors. These 2 scores that are showing low risk, that are 96 and 98 out of 100 score, with 100 being the highest, this is why we're going to get the best interest rate. So you see the difference? You see why this company is going to get more money, better terms, better interest rates than what you're going to see with the other example, because with the other example, we've got a very low score. So it's low to medium risk. It's not low risk. And then we have a low recommendation of credit. This is the difference between you getting the money that you want to get at the terms you want to get, or what you might be looking at now. So when we're trying to get the most money at the best terms, we have to build our business credit, because by building business credit, this is what gives us a history where it helps us get the recommendation for credit up, meaning we get higher approval amounts. And it's also where we get good scores because we pay our bills as agreed. And that's what actually ties in and is the key to us being able to get long terms and low interest rates, which helps us get a lot more money with way lower payments. And Mike, thank you for coming in for St. Louis. If you're just coming in, come in and say hi. So if you want to avoid high future business loan rates, the first thing you have to do is you have to build that business credit. You have to intentionally start building business credit. You have to pay your bills on time or early. It's the main number one factor that ties into your credit scores. You need to make sure that you're getting credit with credit issuers that are actually reporting the credit that they're giving you. And you need to be monitoring your business credit reports so you can actually see this in real time on what's happening on your business credit reports and what lenders and credit issuers are seeing and know about you. Now, the next thing you want to do is you want to establish good relationships with lenders. Okay. I just got off a 45-minute phone call with a business banker up in Connecticut. And he said, look, I'm sick and tired of not being able to help everybody that comes through. We deny the majority of people that come through. We'd like to refer them to you to help them get business credit and funding when we cannot help them or they're not getting the terms that they deserve to get. Okay. So the reality is that he has a good relationship with his clients. He wants to help them the most that he can. He's limited on what he can do. So he's even going to look at outside sources to be able to help them solve their problems so they can get the best rates and terms on the financing they're coming to him to get. That is a relationship-based banker, right? He cares about his clients. And because he's building a relationship with those clients, he's going out of his way to spend 45 minutes with me on a Thursday to find a better way to help his clients get more money at better terms. That's what relationships will do for you. Having those kind of relationships with the bank make a big difference. And yeah, they still manually underwrite loans there. He's still manually underwriting loans, not even using technology. And this reminds me of stories where I actually grew up where my dad was a banker. I remember being a little kid where I was crawling around on the bank floor. And I still remember my dad saying, don't hit that button or the police will be here shortly. So my dad would tell me story after story after story about the farm town that I'm in, people coming in with nothing but a handshake and a promise that they would pay back the debt and him giving them the money. And I asked him, I said, Dad, did they ever not pay you back? He said, they always paid me back. It was a very good judge of character. I knew when they looked me in the eye and shook my hand, they were going to do it. Now, things have changed a lot since then, right? But there are still places like this banker I was talking to with in Connecticut where relationships matter, where he has enough pull to get things done. Even if the bank says no, he can turn around and get a lot of those decisions overcome and still get somebody approved, get them more money, get them better terms, all because he has a solid relationship with his clients. How good of a relationship do you have with your banker? Truthfully, what could you do? If you need to get your banker on the phone right now, what could they do for you? The better relationship, the better terms, the better rates, the more approvals, the more exceptions that you're going to get. These front-end bankers have a lot more power and pull than what you may know. So you want to build relationship with the actual bankers that you're working with because this goes a long way to helping you get future higher approval amounts and better terms. And by the way, Auto Clinic of Edmond is in the house. Thanks for coming in. And also, L. Parker, greetings. Thanks for coming in at work listening. Good. I appreciate you tuning in. So the next thing that we want to talk about is we want to be able to communicate with our lenders as well. Look, if you have an outstanding loan, you think you're going to be late, or anything else needs to be communicated, communicate with that lender. Look, so many times I've been in lending for 20 years, and I can tell you what happens. When something goes wrong, everybody goes into hiding. When somebody goes wrong, when a typical broker's helping a business owner get a loan, they go into hiding. You can't get in touch with them. When something goes wrong from the borrower standpoint, like they can't pay the loan payment on time, they go into hiding. It's the worst thing you could possibly do. You want to openly communicate with your lender. We have a merchant account, and whenever we're going to process more money than we typically do, we let them know. Whenever anything out of the ordinary is going to happen, we let them know. It's for the exact same reason, because just by communicating what's going on, you'd be blown away at how much that means to them because they're not used to it. They're used to people having problems and hiding from them, not talking to them, not openly discussing what's going on. So open communication with your lender makes a big difference. Talk to them about what you think is wrong in your business and what you're doing to fix it to make you lower risk. Talk to them about the things that make you higher risk. Also go in, and I like to write a letter of explanation every time I'm applying for a loan. The letter of explanation says, hey, here's the negatives you're going to find about my business, the things you're not going to like. Now, a typical business owner would never do something like this because they're trying to hide it from the lender. There ain't no hiding it from the lender. The lender's going to know these things. But by telling the lender, hey, my credit's a little banged up. Here's why, here's what happened, right? I learned my lesson. And now you can see this proof that I've recovered from whatever that thing is. That goes a long way. The lender's like, what the heck is going on? Most of the time, people try to hide this stuff from us. This person's writing me a letter telling me about the bad stuff. Yeah, because you know they're going to see it anyways. So you might as well as provide an explanation of what happened and then say, hey, this happened. I messed up. Accountability, ownership. They love it. I messed up. It happened. It's my fault. Then I recovered. I learned a lesson. Here's what happened. Now I'm better. And then here's proof that I've improved. See, they're not used to that. They're not used to somebody saying, here's why you might think I'm not a good borrower. And I admit it's my fault. They're like, what is happening? Nobody admits that it's their fault. And then I learned my lesson. Here's proof that I've learned my lesson, and things have been great ever since. So I actually had to write a letter once because I had misdemeanors on my criminal record, right? I didn't even remember. Had to do with like an attractive police officer when I was 20 years old and popping wheelies on a motorcycle to try to get her phone number, all the stupid stuff you do at 20 years old. And now here I am 2 decades later trying to get an SBA loan, and I have to write an explanation letter of what happened. And my letter says, hey, here's what happened. I was a dumb kid. I take ownership of it. I paid a price. I learned my lesson. And you'll notice nothing has ever happened since, right? In the last 20-something plus years of my life, I've never had any other offenses for anything else, right? So this is exactly what I'm saying. You're coming in and saying, I did it. I acknowledge I did it. I take ownership that I did it. I recovered. Here's proof that that actually is not going to happen again. The second thing on their letter of explanation is you should explain to them the good parts. Hey, look, my personal credit may be a little banged up, but I also want to let you know I have really well-established business credit. My business since inception has paid its bills as agreed. And you can look at my business credit reports and see I have a lot of accounts on there with perfect credit history. That is what we call a compensating factor. So I'm saying, here's the negative: ownership, accountability, learn my lesson, moved on. By the way, don't just focus on the negative. Look at this positive over here. Consumer credit's bad. Business credit's good, right? So this letter of explanation gives you a chance to acknowledge and basically explain the negatives the lender is going to see, and also gives you an opportunity to then give them other things they might not be thinking about that are positive factors to actually get that deal done. And this all comes by communication with the actual lender. And again, if you're just coming in, give me a shout out. I want to give you a shout out right here on the actual live stream. So next thing, consider different kinds of financing. Look, if you want the best terms that exist, it's not really based on credit. It's based on collateral. Meaning if you want to get the best terms, what you should do is get loans that have some kind of security attached, some kind of collateral that you can pledge. If you have some kind of collateral, stocks, bonds, 401ks, IRAs, your house, maybe inventory, equipment, real estate, that kind of financing is going to get you better terms. So anything you could do to pledge collateral, secured loans, that's going to get you better terms, right? Government-backed loans like SBA loans, those are going to get you better terms as well. And then alternative financing options that focus on your strengths and ignore your weaknesses will also get you better terms as well. So for example, if I'm trying to come in and my revenue is good, it's consistent, it's regular, it's growing every month, I've got increasing revenue, I've got increasing profits, I manage my bank account responsibly, well then if I go to a revenue lender, I'm probably going to get decent terms if my other risk factors are low. Because the one thing they care about, my revenue, is managed responsibly. But if I went to that same lender and it's a mess, my revenue is up and down every month. Some months I have negative balances in my bank account. I have non-sufficient funds going on. That's going to make me high risk with that lender because I'm high risk on the one thing they care about, which is the consistency of my revenue. As a matter of fact, if my consumer credit is good and my revenue like that is bad, then I don't even want to look at a revenue lender. I want to look at somebody that's looking at one of my good strengths, not my bad strengths. So remember, all online, alternative, fintech lenders are mostly looking at one strength: cash flow, credit, or collateral. Figure out which strength they're primarily making their decision on. And if you're not strong in that area, don't apply for that type of funding that looks at that strength. Find one of your other strengths and go down that road instead. An example, if your consumer credit is damaged, build business credit. Now we're using the good business credit to be able to get high limit credit lines and telling the credit issuer they can't even look at our personal credit. So now we took something that would have got us really bad terms, bad credit, and we eliminated it from the picture altogether. Now it's not even a factor. Now they're making the decision only on good business credit quality, and therefore I get better approval terms. So this is where we really want to focus on alternative financing options that looks at a strength that we actually have and ignores the weaknesses. And you got to make sure you don't go with the weakness, damaged revenue, damaged personal credit, no collateral, and then try to go hunt a lender in that space that looks at that thing if that thing they're looking at is not a strength for us. So again, if we can help you along the way, let us know. Like at Credit Suite, this is what we help you do: improve your fundability, build your business credit, and get financing. We do an evaluation of where you are, what your strengths and weaknesses are, then find the right alternative lenders that look at your strengths and ignore your weaknesses. And that goes a long way to getting you the absolute best terms. The next thing is shop around, compare offers. This isn't like a consumer credit world where they're putting an inquiry on your credit report every time you apply and it's damaging your personal credit. In this world, you don't get any damage for inquiries on your business credit reports. Now, don't give them permission to keep pulling your personal credit, but the key here is that you can actually shop around. If revenue is my strength and I'm going and dealing with a revenue lender, then I'm going to go talk to 2 or 3 revenue lenders. I'm going to let them all give me approvals. Then I'm going to compare the approval and go with the one that I like the most. Now, if I like this lender, but they didn't give me the best term, then I'm going to go to that lender. I'm going to say, I'm going to be honest with you. I like you more than the other options that I have. I like you for these reasons. But here's the reality. You are not the best. I'm getting better terms over here. So I would rather get better terms than go with someone that I like. So I'm about to take my business over to this lender because their terms are better. But I like you better. So I'm giving you a chance to come back and actually match the terms that I have. I think this is interesting. If you saw the movie about Nike actually wooing Michael Jordan, right, with Matt Damon, and it was phenomenal. I liked it. I took the kids, not the best movie for the kids. They were bored. I think they almost fell asleep. But it's interesting because in one of these cases, if you see a follow-up interview from Michael Jordan, he said, that all happened. And he goes, what happened was Nike gave me this offer, and they actually offered me a percentage of the gross sales of everything that had my name. I went back to Adidas because Adidas is who I liked the most. And I said, Adidas, will you match this? And they said, no, they wouldn't match it. And guess what? The rest is history. Now Nike is all Michael Jordan, right? It's all Jordans. Think about how much money that's meant to the company. Trillions of dollars potentially. But he gave the company, he liked the chance to match the terms he got. They didn't match it, and the rest is history. So again, this really matters. Go to the lender, compare, shop around. And even if you have a lender you love, it's easier to go to them and say, somebody else gave me this terms, will you match it? And guess what? They're not more than likely going to say, no, get out of my face. Why are you shopping around? They're going to probably see you smart for doing that. And they're either going to say yes or no. That's it. They're just going to say yes, or they're going to say no. But you never know unless you ask. That is one of the best pieces of advice I've ever given to my daughter, except she takes it way out of control and asks for everything in life. But it's interesting to see how much stuff she gets just because she asks. So make sure you come in and make sure you are shopping around. Make sure you are comparing offers. And lastly, on that point, negotiate. Okay. If you don't like what you're getting, negotiate. Tell them, say, look, this doesn't work for me because the term is a little bit too short. If I had 6 months longer, it would work better. I don't like this because the interest rate is this. If the interest rate was a little better, then I would probably do the deal. Do not see any approval as the final offer from the lender. Okay. I can't tell you. I went in and got an American Express card. I do this, by the way, on every single credit card I get, 100% of them. I get approval. I call the credit card issuer and say, I'm disappointed. I didn't want this. I wanted this. And you'd be surprised. Sometimes they say, sorry, nothing we can do. Sometimes they don't. Like American Express has doubled my credit limit just because I asked. Because I said, hey, I don't like this approval amount. What approval amount are you looking for? Like double that amount. They went in, they redo the application, they approved me. Bank of America did the same thing. Bank of America actually approved me for a credit line in my mortgage company. And I went to them and I said, I'm not going to accept this. I don't want this credit line. Can you shut down and terminate my application? They said, why? I said, because I have another line that's significantly higher than the one you're giving me. They said, how much do you want? I told them. They immediately increased the line to that amount. You never know unless you ask. So negotiate rates, negotiate terms, negotiate approval amounts as well. All of that makes a big difference. And MacGyver says, hey, and by the way, MacGyver, I love that. I don't know if you did, but when I was a kid, it was one of my favorite TV shows, MacGyver. I haven't had a paycheck in 2 weeks, but my next check will be huge. Drawing inconsistent income. Yeah, I mean, look, that's a problem. And that's exactly why you probably want to come in and make sure you're building your business and be able to do it in a scalable way. Capital will help you do that, because that will help that stop that inconsistency and actually give you control of your own future. And if you have the capital to do the marketing, to do the leads, to do the sales, you can create that kind of consistency to have scalable, consistent growth in your business. So the next thing is take advantage of the economic climate as well. Okay. So what I mean by that is that, look, sometimes lending is well, sometimes lending is not well. Right now, interest rates are high. So there's fewer people out there looking for funding because interest rates are higher than they were 2 years ago. Use that as an opportunity. Okay. Lenders are not desperate. They're more willing to make concessions now than they typically are, because they're not flooded with applications like they normally are. So when that happens and you see rates go up and down and the economic climate goes up and down, and during COVID, less people are applying, for example, because there's this unknown factors, whatever it may be, when the economic climate changes and you're starting to see on the news that loan applications are down, well, then that's probably when you want to look at really applying. Take advantage of that opportunity, right? I don't know what Warren Buffett says on this, but he basically says something like the best time to get in is when things are down, right? Or when things are like not going well. Everybody that's coming in at the best, usually they have less money that they can make on the top end. But when you're coming in on the bottom, well, then there's all kinds of upside. So kind of similar here with the economy. When the economy is not doing great, lenders are actually not getting tons of applications. Well, then that's a pretty good time for you to consider applying. You have more leverage than you would if you don't actually go in when they're actually busy. And the last point I want to make is shortened loan terms can actually hurt you. So what I mean by that is that most people in the business space, most people that borrow money are more concerned with interest rate than they are with loan term. And I can tell you that's the wrong way to go about it. If you want the lowest payment, which let's be honest, that's what you want, then you would rather have a higher interest rate in a longer term than a lower interest rate in a shorter term. And I'll give you an example. We do a lot of approvals for a product called revenue lending. It's where we just give money to people in 72 hours or less just because they have consistent revenue. And those people oftentimes get two different options for approval: a long term and a high interest rate, or a lower interest rate and a shorter term. 9 out of 10 times, everybody voluntarily takes the higher interest rate. And they take the higher interest rate because it comes with a longer term and their payments are less. So they can borrow more money with lower payments. The reason I'm telling you this is that the term of the loan, if you're getting a loan, matters way more than the interest. And the interest is tax deductible. You're getting it back anyways. So you're better off to find the longest term that you can get. That's way more important than finding the lowest interest rate. If you do that, that is what keeps your payments low. Look, there's a reason I had a $4,600 payment when I borrowed $325,000, and at $75,000, my payment was twice as much. The difference is that one of them had a 2-year loan term, one of them had like a 20-year loan term. And that loan term is what allowed me to borrow like $250,000 more money and keep my payments half as much. It was not the interest rate. It was actually the loan term that made all of the difference. So term, way, way more important than rate. So hopefully you got some value from this training. My goal today is for you to walk away with a lot of really effective, actionable strategies to be able to avoid high interest rates and get more money at better terms. If you missed any of this, go back to Facebook, go back to LinkedIn, go back to YouTube, wherever you're watching it, and watch this in its entirety. It's nothing but a spitfire of all my best actionable advice to get you the best interest rates on all your future funding. Hey, and by the way, don't forget, at Credit Suite, this is what we help you do. We help you improve your business credit. We help you improve your fundability. We help you get loans and credit lines to grow your business. Even if you've been turned down before, you're not getting the best rates and terms you want to get, give us a call. We have a free finance assessment at creditsuite.com/consult, where we'll actually meet with you, give you tips to improve your fundability, tips to build your business credit, and tell you all the funding you can get right now. And if you got value from this training, make sure that you like and subscribe and keep your eye out for our next training. We talk about more cool ways to get the money you need